Financial Podcast, helping you think different about your money, your economy, and your future.
Welcome, everybody, to the Not Your Average Financial Podcast Live. We are so glad to have you here, and I am so glad to be hanging out with my esteemed colleagues. Let me just bring them in and introduce each one. Amanda Neely, welcome to the show today. How are you doing?
I'm doing great, Mark. Thanks for having me.
So glad to have you. And Evan, welcome back, sir. As always, both of you guys are returning rock stars, ready for your reunion tour. It's almost it's great to get the band back together. So how you doing, Evan?
Fantastic, man. Yeah. We're basically like as famous as the Eagles now. So
that's right. Yeah, we're right up there with the Eagles.
Mm-hmm.
All right. Love it. Well, glad we could do this, guys. One thing that we're going through right now in this podcast series is called the Ninja Belts series. And if I can give sort of a quick background on this, it's really just it's a way to discuss the use of these policies from simple to complex. And, everybody has their own sort of vantage point of what they feel like they can do when they first learn about this counterintuitive way to build real wealth outside of Wall Street. One way is, of course, the Wall Street way. Another way is bury your head in the sand and just put it in a bank account kind of way. Or there's this counterintuitive way of learning to do what banks do. And today on our live, we're going to be discussing how banks include life insurance as an asset class on their balance sheet and why they buy as much of it as they possibly can. But from the beginning to the very complex, I want to cover quickly in like rapid succession how the Ninja Belts really work. So, there's the white belt, and you might say that's the easiest belt, but actually it might be the hardest belt because you're having to get up off the couch and actually get in the dojo and step onto the mat. And in many ways, the white belt could be the most difficult belt, as it helps you live within your means for the very first time. You're able to save on a monthly basis or annual basis something that you're not spending. So capturing your cash flow so that every dollar has a job to do. The yellow belt, policies that are, really ensuring the most important people in your life, not just ensuring your own life, but now you're thinking about your spouse or your kids or your business partners. The orange belt looks at your past problems, the debt you may have accumulated, and it uses the debt snowbank method to wipe out the debt and truly become not just debt-free, but better than debt-free. The red belt, protecting your business and your retirement. So becoming your own line of credit for your business, or taking big distributions from your policy to fund a life insurance policy so it goes from a taxable 401k, or for example, to a after-tax, non-taxable or tax-free even life insurance policy. There's a few more, but guys, any feedback on those first couple of belts? Anything that you've experienced, either yourself or with clients?
When you said the white belt one, it kind of reminded me of like going from 0 children to 1 kid. Mm-hmm. And I don't know, people have different opinions about this, but that was like the biggest leap of all of them. And going from 2 to 3 kids was the second place biggest leap for us. And so they say. I only have 3, but they is, and people who have more than 3 say, it's just another kid after that. So, that's definitely a big jump on point. For your financial well-being. I've talked to a lot of people who are just starting to think about their finances, quote unquote, and that, that's a really great place to start. And I'm so glad to hear every single time that I hear somebody say that. I'm like, awesome, let's do it. Like this is going to be a game changer for you and your family. So keep up the interest, keep up the momentum. There we go.
I like keep up the interest too. I like the pun, man. No problem. Yeah. Amanda, have you seen those belts in place in any of your clients or your own life?
Yes, of course. Yeah. Which belt was it where actually, can you pull them up again? Yeah. The snowbank method, the orange belt. That was one that I used. Got rid of my student loan debt in about 2.5 years. Instead of paying extra student loans, put that into the policy first, and then borrow when the policy's loan available matched the student loan balance. Just took out the paid the minimums all along the way, right? And then just took out the loan and wiped out the student debt, had a big party, even if it was just, dance party with some good music. And then started repaying myself. And that's actually analysis that I've done with folks like a 20 something doing the snowbank method to do something like get out of student debt ends up having 100,000 more in retirement because of all the growth they get that they didn't lose out on. That mine might be a little bit less because I started a little later, didn't have as much student debt as that person, but can be a big difference. Just, same money, just applied differently. Huge.
Man, that's great. So we've had a lot of fun already, but as we continued in our journey of the Ninja Belts, we've talked about the red belt. We got into the green belt, which really becomes where we move past specific, I guess, approaches or systems and get into more of a portfolio of policies. So every policy now might just be purposed with a certain intention. Like I've got one life insurance policy, that might be the white belt or yellow belt, one policy, let's say. But if I've got 7, 8, 9, 10 policies, each policy really needs an intention behind it. Like this is your business policy. This is your cars policy. This is your, future kids college fund policy. And this one's just for retirement. It could be really a system of policies over time that's all building with certain intentions. Then we got to the purple belt where we talked about those large, regular, recurring expenses. I met a guy yesterday who has to pay $600 a month every month for his taxes, plus he owes 25 grand at the end of the tax year. And he's not sure, one, how he's going to pay that 25 grand, but two, every time he does pay it out of savings, it just disappears. What if you could run your annual tax payments through your policies? So that's the purple belt. The brown belt then creates a true family banking system. Now, this is more than just getting a policy on your family members. It's really, truly creating a family wealth office to wrap around those policies, to meet regularly with your family members, to say, hey, you know what, Susie, you want to start a business, don't get an SBA loan. Come to the family banking meeting that we have 4 times a year and request a loan from the family. And let us be your bank in many ways. So that's the family banking system using the brown belt. Now that's how far we've gone. Before I get to the black belt, which is what we're going to discuss mostly today, guys have any comment or engagement with any of these belts? One more time on the screen.
The one that speaks to me a lot is kind of a combo of the red green. Because like protecting your business in retirement, particularly for business owners, that very much goes hand in hand with their cash flow.
Mm-hmm.
And I love talking about how, adding the policy and getting more clear on business cash flow can actually strengthen the business at the same time that you're strengthening your own retirement, regardless of what happens to the business.
Sure.
And to combine profit first with banking yourself in that way is just, I don't know of many people doing that. But it's like in terms of teaching that, but lots of people are doing that, and we're part of who teaches people to do that. It's great.
Fantastic.
Yeah, I really like the brown belt one. It is probably like one of the cooler concepts that I've heard of having your own family banking system and everything. Like, I just think that's so cool. If we had, that growing up as a kid, like that would have been just absolutely incredible. I mean, anytime that we needed to, buy a car or make a major repair or something like that, or invest in real estate, I'm so glad that I'm setting it up so that next generation can do it.
Right.
Won't have to say, my kids and my nieces and nephews are not going to say the same thing that I've just said. Wish I could have done this when I was a kid.
Wish I shoulda, coulda, woulda. Yep.
Mm-hmm.
Yeah, and it doesn't have to be that way, guys. If you're watching this, you now know what's possible. You know that this is an option for you and your family. So what's holding you back? So before we dive any deeper, I want to add this little comment or question for everybody. If you're listening and watching to this, make sure you're putting your questions in the chat. We want to bring your ideas, your insights, and illuminations into this conversation. So make sure you're putting your comments down below. And I'm curious too. Has anybody here ever had a multi-generational family system? Is anybody here working on building that brown belt? I'd love to know if that's something that you're doing. Please put it in the comments below. We'd love to bring you your comment live and discuss it some together. And if you've never done it, that's okay too. Maybe say what it would feel like if you did. All right. So would love to know your thoughts on that as well. So guys, what we're going to cover today is the scariest one, in my opinion, and it's called the black belt. Now, scary is really just it's sort of a silly way to talk about it, but the black belt, and we talk about it in episode 460 of our show. It just came out today. It's really something that goes clear back to Nelson Nash's book, Becoming Your Own Banker. And, that's sort of the foundational text that sort of prompted this revolution of thinking and acting differently with our money. To think like a banker really assumes a certain presupposition that, your money in your own bank is better than your money at somebody else's bank. And the truth is, all of us keep our money somewhere. And the question is it at your bank or is it at somebody else's bank? So the essential definition of the black belt is 100% income integration. The idea here is that your premiums, the money you put into one of these or multiple policies, equals 100% of your total income. Every single dollar that you're earning goes into policies through your private banking system first, and then you access that money through policy loans to use what you need to live on, if it's your personal, or your business uses for operational expenses. So we talk a lot about Profit First, as Amanda Neely is one of our she's one of the best Profit First professionals I've ever met. And just crazy smart with that tool, as well as the Bank on Yourself strategy together. Most of the time when we integrate Bank on Yourself and Profit First, we might use Profit Hold, or maybe the tax bucket, or maybe some other one or two buckets. But Amanda, this would also include, for the business owner, every bucket would be going into policies. You'd still have a checking account for buying your equipment or your inventory at Home Depot or whatever. But all of your money that you'd use for OpEx would come from a policy, go into your checking account, and then you'd spend it at the shop or buy your inventory with it. So we'll talk more about some of these key moves on the mat here. But if you think about it, why would you keep any of your money in somebody else's bank if you could keep it in your own bank? And that's the ultimate question with the black belt. Guys, any gut reactions to this black belt method?
Yeah, your description of scary or whatever it's just intense. You need to be sure that you have sufficient cash flow and that you're able to kind of keep track of things. So it's important to set up the system before just jumping in blindly. But so instead of scary, it may seem daunting to set up at first, but it's kind of one of those things that once you get it set up, it can help substantially simplify the process. I mean, if you think, I like your question you ask all the time, Mark, like, this is really hard, this is really challenging to understand. Well, compared to what? When's the last time that you went and got a loan? That's not
Right.
super easy to do all the time. I've had to jump through a tremendous amount of hoops and to get declined,
Totally.
sometimes. And if it's not a deal that the bank likes or something like that, they can say no, and they don't have to lend you the money. And in this case, like, this is your bank and you get to decide. You have the control over that and the repayment schedule and everything. You're not going to get foreclosed on, things like that. Those are some really amazing things that really make it a whole lot simpler compared to the alternatives.
So, Amanda, any exposure to this black belt in your conversations with clients? Do people ever ask about it or even implement it?
It is something people ask about a lot, and a lot of the thing that I think is something that's hard is that you can't start here. You do have to
Mhm.
start at one of the other belts and grow your way to this, particularly because, life insurance companies, you have to prove you have insurability. And if you're going to
Mhm.
put more than, say, 20% of your income in, we got to make a case for that and explain why and all those things. And so it's easier to like grow into using multiple policies, like across different people being insured, things like that.
Mhm.
um and then I love reminding people like the Nelson Nash rule: think long range. Eventually, if we've done our jobs right, everyone's going to be in the black belt, um ish, because
Right.
all of their income's going to even be coming from their policy or a good
Yeah.
majority of it. And maybe social security might be there, maybe you might still have, a pension or something like that. Well, you've got more options then, right? Like,
Mhm.
and so it's fun to like say like, well, maybe not today, but let's dream of that in the future. What could this look like?
Ooh, that's cool. Yeah. Yeah. So, do you guys find that some people, by nature of their exploration of this concept, stumble into the black belt, at least in their theory and in their research? Do they come to you and say, "Well, wait a minute, Amanda, if this is all true, then why shouldn't I just put all of my money into life insurance?" How do you react to that?
Yeah. Well, um, just like what I was saying, like, sure, that
Mhm.
might be true eventually, but we can't start there
Yeah.
because we do have to cover, things like the cost of insurance at first, things like that. You're not going to have 100% available, but also you probably can do more than you expect at the beginning because there is more of it available, and you already have some leakage and, things like that. And so
Mhm.
it's, if we can, like, if people want the black belt, the white belt's way easier for one.
Yep.
And usually they're ready for, something like orange or green as well.
Cool. So, I think all of us would say yes to the black belt with an asterisk, but yes, and. What is the and? What are the risks that we need to be discussing as, helpful financial professionals, bank on yourself, strategic professionals that are looking out for the best interests of our clients? What can go wrong with the black belt? You've already alluded to some of this, Amanda. So when I put, let's say I make 100 grand a year, if I put $100,000 into a policy, if I even can be approved for that, let's talk about that for a minute. What are the risks of doing the black belt?
Well, how much do you spend of that 100,000?
Mhm,
Right?
mhm,
It
yep.
depends on how much of it you spend. And if you're going to spend more than you'd have available in loan value that first year, then it's not going to be there to spend. I know we're going to talk about banks. When are we getting to that? And then what
Ooh,
banks do, and how much of their money is going into life insurance? Because I feel
yeah.
like there's a parallel here.
Well, yeah. So, it's important again to think about that. So we'll come back to the risks because I don't
Okay.
want to bypass that all the way, but let's jump into it now. Why not? So, the important thing here, Amanda, is again remembering that my money has to live somewhere. It's got to
Mhm.
live somewhere. If I can get my screen to share, I'll go through a little walkthrough with everybody on this and see if it makes sense for everybody else. You tell me if it doesn't. So your money has to live somewhere. Where's the best place for it to go? Where can I put it so it does what I need it to do for me? When you make money, how much of that money, ask yourself, is going to somebody else's bank? Is it going into their ATM and coming out of their ATM? Sometimes they charge you a fee for that ATM. And how would I start my own bank? So here's another question. How many CDs or savings accounts or money market accounts or whatever, how many certificates of deposit does your bank own? You guys want to venture a guess? The answer is
Mm.
none. None. So that's interesting. Somebody once told me this, guys. They said, don't do what banks tell you to do with your money. Rather, notice what they're doing and with their money and go do that instead. So Amanda, I'm going to throw some stats up here, and then I want to pass the ball back to you. Where do banks keep their money? Let's find out. So there are about 3,800 banks in the United States. They have about $190 billion in cash value life insurance. This is something Dave Ramsey, I'm sure, stays up late at night wondering about. Why in the world would banks put all this money, not a small amount, like a lot of money, in cash value life insurance? Well, Bank of America, it's one of their biggest assets. It's actually worth more. $22 billion of cash value life insurance is worth more than all of their real estate combined. Citibank has $6 billion, and it's their single largest asset. And they have less than $5 billion in other assets. JP Morgan Chase has $11 billion in cash value life insurance, which is 50% of their total assets. You know, they've got $22 billion altogether, and 50% of it, $11 billion, is going straight into cash value life insurance. Wells Fargo has $19.3 billion and only about $10 billion in other assets. So what is it that they know that we don't? Well, that's fascinating. In fact, banks get as much as they're legally allowed to buy. They buy as much life insurance as they're legally allowed to buy. And they cannot just buy as much as they want. They have to be constrained, but they get as much as they're legally allowed to by regulators. It's called Tier 1 capital. And so by law, banks must keep a percentage of their assets in Tier 1 capital. But using cash value life insurance is so attractive, the Federal Reserve had to make a rule to limit how much cash value life insurance banks could buy. That's fascinating to me. I find that really interesting. So passing the ball back to Amanda, why in the world are banks doing this?
So I shared a couple links. I can't share them to the chat on the YouTubes and stuff. The first link.
I'll put it in there. Yeah.
Okay. The first link is where you can look up how much life insurance your bank owns. So if you did not have a bank that or if you have a bank that Mark did not list, great place to look it up. And then the second one is there's a few things you can look up, like FDIC and what they say about how much permanent life insurance a bank can own. And this is like an executive summary of and there really is a limit on how much permanent life insurance a bank can own depending on their size. And when you were this is part of why I was like, we should go here, is because you're talking about risks. Why would the FDIC limit how much banks can own, right? Like, is there a risk to it? Right. And then obviously there's an appetite that they want more. Why would they want more? And then why would the FDIC limit that desire? You know, it's like they want to eat a huge bowl of ice cream, and the FDIC is saying, nope, you can only have one scoop. But like, right. What are your guys' thoughts here? I know we can't read the minds of FDIC, but
yeah, it's a matter of like just figuring out why the government would put a limit on that. And I think the reason being, a lot of people are in government rather are seeing dollar signs, you know, leaving their pockets because of the tax efficiencies. There's so much tax efficiency that comes with setting up this strategy for yourself and for your business. You can access money without paying taxes on your terms when you want to, and then whenever the money is passed along, it's passed along tax-free through the death benefit. And until they change that rule, this will remain the case. So I don't think that they're ever going to change that rule, though, because there's so much interest in this strategy with some crazy, super uber wealthy people that have a lot of sway. And the best they can do is just limit and make it a little bit more challenging. And so why would they do that? I think it's to stem the abrupt halt to the tax dollars leaving the government and not getting to the government, rather. So, yeah, that staunches their bleeding a little bit. So
it's interesting. That's an interesting take there, Evan. I hadn't thought about that, but you know, it's the same reason why maybe we had a similar constriction on single premium whole life policies in the late 80s. You know, the very wealthy were using life insurance as a tax dodge to avoid some of the major, you know, constraints that they were experiencing with real estate. Do you guys remember there was the real estate mortgage, you know, increase in the early 80s? And so as a lot of the real estate tax law changed in the mid 80s under Reagan and the rest of the, you know, Tip O'Neill and all those guys, they decided, they meaning CPAs and their rich, wealthy clients, decided to move much of their money into these really snazzy single premium whole life policies that were also beautiful tax dodges slash income tax free machines that would begin developing massive cash accumulation. Once again, avoiding the government's, you know, reach. And so in 1987, they passed the TAMRA Act, which limits how much you can put into a single premium life insurance policy in a single year. You got to spread it out over a couple of years. So maybe you're right there, Evan. Maybe there's some. What do you think, Amanda? Is there any insight you have in this question?
Well, do you want to put on a tinfoil hat for a second?
Yeah. Where is mine? I forget where I keep it. Yep.
Okay, so I was recently learning about Uber and car insurance. And Uber drivers have to put a certain dollar amount or certain percentage of every dollar they make per mile driven into an insurance pool. And then Uber like carries that insurance and it helps make sure if somebody gets hit while an Uber driver is on a trip, right, there's liability and coverage and everything. Well, turns out there's enough money that Uber actually self-insures.
Mm-hmm.
Uber has a car insurance company. It's based in Hawaii and they self-insure and they have billions of dollars in this pool. And they're trying to actually get some laws changed so that they can do something different with this money. It's a whole big thing. I'm not sharing this to be political or anything. I'm sharing this because, like, if you're a bank and you've got billions, trillions of dollars and you want to buy life insurance, you might set up your own life insurance. You might be big enough that it can be a captive insurance company where you're the only owner of that company. And then now you've got a bank self-insuring itself and like all these things, right?
Yeah.
And that could be really scary. Right. So maybe they're limited, so they have to spread it out amongst other actual insurance companies. So they're not even too much bigger to fail, right, than they already are, like those kind of things. So, because we want to spread that risk. Whereas if it got too big, that they could do some of those things to move it in-house to self-insure as we speak, that actually increases their risk, not decreases it.
So good. So we have, I think that's actually a really awesome take there, Amanda. And the key here, though, guys, is watch what banks are doing with their money. They have figured this out 100 years ago. Okay. Why didn't they tell you? And why haven't you followed in their footsteps yet? It's been a whole century. You had plenty of time. Now's your chance. You're hearing it from us. So now's your chance to do what the banks are doing with their money, not do what they're telling you to do with your money. Okay. So Mr. Bob Hughes, 5369. He has a comment here. I want to bring it up on the screen and get everyone's reaction. Bob writes, how can we incorporate the model of planning using a best case, most likely case, and worst case scenario planning? Okay, so how can we incorporate the model of planning using best, most likely, and worst case scenario planning, beginning with the end in mind while working through the belt system? And then he says this follow-up here. He says, especially when eyeing Nelson Nash's suggestion of running expenses through policies like the Black Belt. So how can we have that model of planning using best, most likely, and worst case scenario? What would you guys say in response to Bob? Amanda, I saw you clapping. I'll pass the ball to you.
Okay. Sorry, Evan. Jump in here. I think of this book. And
what is that book for those listening?
The Bank on Yourself Revolution by Pamela Yellen, the older version. The newer version has an update to this. So you maybe just skip there, but I'm most familiar with this. Chapter 11 talks about the Austin family. And it has this really cool
Here, let me get you expanded. I'm
milestones.
going to see if I can put you on the big screen. Whoop.
Oh.
Let me get Amanda on the big screen. There we go. Go for it, Amanda.
Okay. Life milestones for the Austin family, page 239. Tim Austin created this chart way back in his 20s. in
Mhm.
the 90s, and it builds out. Here's when he's starting new policies. Here's all the things he's using his policies for. Now, obviously, it hasn't worked out totally according to plan, and he's using cash values and death benefits, with the dividend scale, right? Of actually, it says down here they're projected using 2011 dividend scale, so they updated that, at least that, in the book. But you create something like this, you can do a guaranteed, because that's the worst case scenario ish, right? As long as you pay your
Mhm.
premiums. You can do current dividends. That's kind of the most likely case. And then your best case, it's like, and if I get this windfall, and if I want to, like, add this other thing that could happen, or if my income increases, right? Then you get into the, like, let's create play money for best case. But I
Mhm.
love this milestone chart, and it's something that can kind of, each decade or each year period, you can see, like, here's how I'm going to use the policy, here's how it's going to build, here's when I have all my loans fully repaid and graduate into black belt from there, or before.
Love it, Amanda. Great stuff. Evan, what about yourself? What would you say about Bob's comment?
Yeah, I mean, Bob is a good friend of mine, by the way. I love this guy. He has some brilliant questions, and he's very well read. But taking it a bit further from what Amanda just said, like that's just like one family unit. Zoom out and include generations,
Right.
and set generational goals. I mean, what is it? The Chinese think 100 years out into the future. They're not just thinking
Sure.
like 5 years out or 10 years out or even 50. They're looking 100 or even 1,000 years out into the future, and trying to make their best trajectory possible. And so you you set the person who's here today is the pioneer. They're looking out, and they're trying to set the trajectory in the right to the right setting, and keeping it on track as best as they can throughout their life. And then teaching, not just doing it for their life, but also teaching and preparing who else is, the one who's going to pick up the mantle from here, from whenever I pass away. They're going to need to be prepared and set up for success to continue on and making it even better.
You bet.
Doing an even better job than I was able to do, and so on for the next generation, the next generation. So having that foresight, those planning, aspects involved in this, talk with your family, setting expectations, creating a system for people to actually make this stuff happen is critical. It's key.
That's good. Bob writes, military planners spend so much time and focus on the worst case scenario. We try to answer the question of, if my assumptions are wrong, can I still accomplish the mission? It's a great question. That's a great question. Assumptions are king. So I think so many so average financial advisors will say, hey, look at this rosy picture. You know what we're going to do? We're going to, the market has given us an average of, false claim per year, whatever it is, 12%, 10%. Well, that's a little rosy. So we're going to give you 8% per year. They're going to give some other average rate of return. And that's going to be what they say is their worst case scenario. Well, that's not a worst case scenario. That's still beyond rosy, in my opinion. If you look at what an average rate of return is versus the real rates of return that folks might get in the market, it's much lower. You pick your study, but Dalbar, recently has put out that real investors over a 30-year period invested in a blend of equity and bond funds are in the middle single digits over a 30-year period. That's before taxes come out. So, if we're looking at, worst case scenario, we should be asking ourselves, if it's the worst case scenario, could we still meet those objectives? I love what Bob had to say here. The previous comment, he says, if my assumptions are all wrong, could I still accomplish the mission? If I don't get the best, rosiest case scenario in the stock market, can I still retire without unnecessary risk? And Amanda said the guarantees on the life insurance contract are literally they are the hook that the insurance company would hang themselves on. If they couldn't make that guarantee, they'd be sued out of existence. You know, if your investment advisor doesn't do what his or her promises, his rosy projections are saying, he'll just say, hey, what the heck, the market's going to do whatever it's going to do, and move
Sorry.
on. And you got to deal with the consequences, buddy. Sorry, thanks for your fee. That's not the kind of financial life or the financial advice I want to give as a professional. So, it looks like Bob says, excellent suggestions. Revisiting the Austin example and succession planning were great takeaways. So great job there, Amanda. I think, guys, again, please put your comments in the chat, and we'll make sure to include them as well. So make sure that you're asking your questions, and we'll make sure to bring them up. As we go forward, guys, I was going to bring up sort of a fun numbers experience. Would you guys like a little mathemagic here as we wrap up today? Okay, cool. So again, the ultimate question that I'm going to lead us down this path here today is why would you want to keep any of your money in someone else's bank? It's just foolish. If we look at the traditional internal growth pattern of a paid up addition rider, depending on your age, $1 that goes into a paid up additions rider, if you're 60 and it grows till, let's say you live till age 90, every single dollar you put in paid up additions would build and yield wealth to $5.30. Every single dollar would give you 530% return on your money over 30 years. That's phenomenal. Again, with no market risk and a high degree of confidence and predictability and 100 years of dividend history. That to me is freedom. Now, what if you're a little younger than 60 years old? Well, every dollar you put into the paid up additions rider will grow to $14.10. What if you're 30? That's $24.30. Every single dollar you put into that PUA rider. What is the PUA rider? Evan, can you shout it out, man? What is the paid up additions rider?
Paid up additions is like a little miniature whole life policy that has cash value and death benefit, the same as like a regular whole life policy.
Love it.
And you can actually still borrow and access that. It earns dividend interest and everything still. And it's a one-time fee. That's it.
Now, do you have to be a certain age to have a paid up additions rider, Amanda? Is there like a minimum age limit for PUAs?
1 day old.
Wait a minute, 1 day old? Here I am floating around with our 60 and 40 and 30-year-olds, and we can get this when we're 1 day. Has anybody ever done the math on what a paid up additions rider dollar would grow to if you, let's say you were just 1 year old when you got your policy? Has anybody ever done the math on that?
I bet you have, Mark.
Wait for it. $117. Can you imagine? Now, what if we had 75 grand go into paid up additions? Again, if you're 60 years old, that's almost 400 grand. So if you had a $75,000 payday, maybe you had a business deal close, maybe dear Aunt Mildred passed away and left you 75 grand. You could certainly throw that money in a bank account and let it languish there. You could put it into the market and get beat up by those guys, or you could put it into your policy's PUA rider if there was room for it. And if you're 60, by the time you're 90, it would grow to $397,000. What if you were 40? $1 million. You're a millionaire just in time. What if you're 30 years old? 1.8 million. Are you guys ready for this one? Anybody? Anybody? Want to guess? I don't make people do math live on air. That's not fair. It's $8.7 million.
Wow.
Feelings, thoughts, comments? Evan, why did our parents do this for us?
Well, I know why.
I'm not complaining.
Mine didn't know about it.
Mine didn't know either. Yeah.
And if they had, absolutely would have done it. But because it's not like it. You have to start with millions of dollars in order to start doing this. You can start with, $100 or whatever.
Yep.
Even as little as $50 a month can start a policy. That's about as low as you'll possibly get. But it is just a matter of making the decision to pull the trigger and actually sticking to it throughout your life.
That's right. That's the problem, man. That's right. Most people think of their money in three buckets. They've got, their lifestyle cash, what they had to spend at the grocery store, little bit of money they could save in their savings or 401k or whatever. And then everything else goes into what we call wealth transfers. That's all this stuff. all this
Mhm.
stuff. And this is not just an exhaustive list. I mean, this could be every major expense that just drains the life force out of your bank account. Mortgages, homeowners
Mhm.
insurance. I just saw my umbrella insurance policy went up in price. It's all going up in price. So, your taxes, your estate plan bill, your compound interest on your credit cards, it's all there. So all those wealth transfers, the black belt is all about reclaiming as much of your financial pie, your circle of wealth as possible. Not just the green. That's maybe put the accumulated money in belts like the white belt or possibly the yellow belt and green belt. But the wealth transfers would be where we're getting into the purple belt. And then when we add lifestyle money into your banking system, now when we've absorbed the full circle of your wealth, that is the black belt at work. So don't feel like you should jump right to black belt. Please don't. Start with a little monthly plan that you can afford and not feel too overwhelmed by. But I just wanted to if I've got 5 minutes, 10 minutes, I think we'd have a little fun paying for everything through our policies. You guys ready for this?
Let's see.
Okay. So this is after-tax dollars. Let's say a male who's 35, standard non-smoker. He's putting $64,000 into his life insurance. And I actually designed this, and Marty Smith actually built these illustrations, but I designed this with an all-base policy in mind, just to show you that even an old-fashioned whole life policy can become a banking policy along the way. So you might be able to tell here, guys, that the cash value is 64 grand a year, and his cash value is pretty small, especially at the beginning, but it starts to really build up quite nicely as we go down the page. And as we get to year 30, you can see he's got $3.3 million of cash value, and he's able to live on $175,000 a year. Again, under tax law, current tax law today, that's income tax free from age, to age 100. Not bad. Not bad, right? That's from age 65 to 100 right there. That's a lot of money coming out. Now, what if you're 45 years old? Well, you can still get that same tax-free income of 175 grand a year, but you got to save more money because you've waited longer. So this guy's having to put in 137,000 bucks a year. And again, he gets to live till age 100 on that money, on that tax-free retirement income. What if you're 54 years old? Well, you can do it in just 10 years, 11 years, but you got to save 303,000 bucks a year. So look at how important it is to start saving early. The 35-year-old versus the 54-year-old, but he's still living on that 175,000 bucks a year going to him every year without income tax due, and it takes all the way to age 100. Now, what if you just have 10 years to go, and he's 36 years old? Okay, so our 35-year-old puts in 122,000 bucks a year for 10 years, and then he never adds another penny to it ever again. So this is what we call a 10-pay policy. And he puts that 122 in for 10 years, and then he just lets the thing grow. Look at that cash value growing on its own without him having to add any more money to it. And after 30 years, oh, wait a minute, where have we seen this money before? Oh, yeah. That's 175 grand a year income tax free. So this is why we say it's creating a system of whole life policy loans is one of the best financial strategies ever invented. Now, that's just using it for retirement, but that's fine. That's easy. But what else can we do with it? Look at all the things you can use your policy for to get access to cash with more control and less risk. So this is that 10-pay that I told you earlier, same guy, but now he's taking out loans for cars. And he takes a loan for 55 grand and he pays himself back. Takes a bigger car loan out. Bigger car. Now he's got a sedan. Now he's got an SUV. Now he's got a truck and an SUV. So he's continuing to increase the price of that car. But every time he does, he pays it back, pays himself back over time. And what happens at retirement? He still gets to enjoy the same exact tax-free retirement income. Let me take a breath here for just a minute. Amanda, how can he borrow all this money, pay it back, as you see on this screen, and yet still take the distributions of $175,000 income tax free? What's the function there that allows him to do that?
In technical terms, it's called non-direct recognition, which means that when he's taking a policy loan, he's not taking his own money. He's taking it from the general fund of the life insurance company. So his money is still growing, is still there, growing as if he didn't touch it because he didn't touch it.
There you go. Simply using it as collateral, right? So we're now, again, we're moving up the black from just saving the money. That would be kind of white belt strategies. It doesn't matter if you're saving 64 grand a year, 6 grand a year, or 300 grand a year. It does not matter. That's considered white belt. When you're just letting it sit and sour inside your policy, that's not a problem. We have no shame to the white belters out there. Get on the mat, do your dojo work, do your moves, save what you can, crawl, walk, run, whatever it takes. But as you begin to see the power of this non-direct recognition loan, like Amanda said, you may decide to start borrowing for cars. Why stop there, right? The next thing he figures out is, wait a minute, if I can do this for cars, let me do this for some pretty big, some business equipment. So maybe he's got a tractor business, or maybe he's got a lawn care business, and he buys a bunch of big equipment. He borrows out 400 grand, pays himself back right here. Takes a bigger loan, pays himself back over 5 years. And what do you know, after whatever 30 plus years, still living on that same tax-free retirement income. Pretty awesome. What if he did it for college? So, this 35-year-old has a kid right about here. That kid just so happens to start going to college when he's 18 or whatever. So now he's got 4 big loans that he has to take with really no loan repayment at all. That's pretty awesome to not be forced to repay the loans. And he starts to repay the loan once the kid's out of college. Heck, maybe the kid helps pay that loan back. I certainly would want my kid to pay me back if I had lent him this kind of money. That's whatever, 1.3 million bucks or so, give or take. So yeah, little kiddo, you're paying me back till that thing's gone. He pays himself back. And wait a minute. We keep seeing this over and over again. This income remains the same, even after pulling out millions for college. And here's where things get wild. Let's pay for everything. Here's the car. Here's the car and the business loan. Here's the car and the business loan. Here's the college coming out. Here's the next car. Here's another business loan. It's all happening all at once, because that's how life really works, guys, right? Right? Life doesn't just give you things one spoonful at a time. Evan, does life just give you spoonfuls, or is it going to pour it on you?
It's going to keep happening, man. Life keeps trucking along. So
yep.
You gotta just expand to it. And I was just going to say, this is all of these examples. These are all examples that you're going to spend the money anyways. The only difference here, and you're going to save up these new dollars so that you can have this retirement fund in the future and everything.
There's that retirement.
It's all going to happen no matter what. The only difference is the mechanism that you're using.
Which bank are you keeping your money in, right? So over 35 years, this guy pulls out $175,000 income tax free for 35 years. My calculator says that's $6.1 million after all those purchases. So let's kind of simplify all this. And I promise I'll pass the ball and we'll wrap up here today, guys. One, how much premium did this guy pay in? Remember, it was 10 premium payments. It was a 10 pay for the 35-year-old. He put in $122,000 a year times 10 years. So he put in 1.2 million bucks. That's not chump change, right? What did he use the policy for? He bought $375,000 worth of cars, $3 million worth of business equipment, $1.2 million for college for that kiddo going to college. Boy, what kind of degree is that? Goodness. So that's a grand total of $4.5 million for, his life. And how much did he borrowed out how much? 4.5 million. How much did he pay back? Because guys, Evan, are these loans interest free? Are these just free money from the insurance company, or is there some cost to borrowing?
It's a loan from the insurance company, and you pay simple interest that compounds annually in arrears.
All right. And what does that work out to in this guy's example? How much does he borrowed out 4.5? What did he pay back? $5.4 million. Oh boy, sounds like a ripoff. This is where Dave Ramsey's screaming, right? Wait a minute, you're paying interest on your own money.
It's crazy.
No, well, I don't think so. If you do, you paid $884,000 of interest. That's the total amount that you paid in interest there. So your total outlay, if you add the premium plus the loan interest, was 2.1 million bucks. So there you go. There's the scam, right? There's the ripoff alert. Well, wait a minute. He put in 2.1 million bucks. What did he get back out? What was his retirement income?
6.125 million.
Yeah. Okay, so this is why the black belt attracts so many of our clients. Are we saying everyone should do black belt? Not at all. I'm not saying that. I don't hear Amanda or Evan saying that. What are we saying? We're saying it works, and we're saying it can be a powerful tool if you know what you're doing. So if you know what you're doing, and if your advisor is trained to help you guide you down that path. Amanda, I'm going to ask you, is there a way where you, the potential client, really want to do this, but you find just some Yahoo on the internet who's willing to sell you a giant mega policy, and then he runs off? Is that possible? I mean, I can't imagine that happening, but is that?
Yeah,
is it possible?
Totally possible.
Yeah.
Mhm.
Yeah. I mean, it happens too often. And it happens to some really famous people where they get oversold something and they end up with nothing to show for it later.
Are you thinking of just somebody recently? Because
Yeah.
there's plenty of folks. Are you thinking about who are you thinking about there?
I mean, I don't know all
Name
the details,
names.
but Kyle Busch, the NASCAR driver, I
Mhm.
don't know any other NASCAR drivers. I'm not a NASCAR person, but that still landed in my news feed from,
Mhm.
actually not even my news feed, a private message from someone. Did you see this? Because they knew I would care about it. And I did. For those that don't know, so he bought an indexed universal life policy, put millions of dollars into it, and lost it. It was gone.
Mhm.
And he ended up suing the company. They settled earlier this year. We don't know what they settled for. It's sealed records. It's private. No one will ever know unless, like they probably can't tell the family or anything. And then he passed away a couple months after that. Hopefully his family got something. Hopefully at least what they put into it. Who knows if they still had some kind of policy, but he definitely didn't get $6 million of retirement income. And actually, this is a good point too. Part of why I was thinking about this is as you're showing that example, we didn't even talk about, what if he dies halfway through this plan?
Wow.
Right, your example, the 35-year-old
Yeah.
male buying this policy. He started with a $4 million death benefit that grows.
Sure.
What's his family get if he doesn't get to complete the plan?
Yeah.
At some point, they're still getting $6 million that they
Wow.
can use for their own retirement, right? If this person's married, the wife still gets to, have that income.
Wow. Yeah.
Right? Like we always forget when we're focused so much on the cash value that if you don't get to complete the plan completes itself for you. No matter,
Amazing.
it repays the loans and then the rest goes to your family or whoever you
Really
deem as
remarkable.
beneficiaries. Yeah.
So good. Guys, this might be a good stopping point. So if you're listening to this and this has got your hackles all up, or you're interested, we don't bite. We'd love to discuss this privately with you. Again, are we telling everyone that watches this to go do this? Not at all. It shouldn't be your plan. Everybody who does Kung Fu does not need to be a black belt. You can have plenty of enjoyment at white belt or yellow belt or what. Just get into the groove of making those ninja moves happen, and you'll benefit from it. Just getting onto the mat, off the couch and onto the mat is, maybe the best move you could make today. So we're not saying everyone should go jump and go do this, but the concept is real and it's true and it works. It works if you follow the moves. So with that, I'm going to pass it to Evan first. We're going to go back to Amanda, then I'll close this out. Evan, how can folks find you and get to know the work you do, and maybe ask you some of the questions that have been on their mind about this black belt strategy? Oh, you're muted, sir.
You can go to Great House FS, which is greathousefinancialsolutions.com, greathousefs.com, and there's a link on that website that will give you access to my calendar, and you can book time, any available time. And I would be glad to just start with a quick introductory phone call where we just take 15 minutes to even consider if this is worth putting the time and energy and effort into. Your time's precious, so is mine. And I'm happy to tell you right out of the gate if this is not a strategy that I would recommend for you.
Great stuff.
I don't beat around the bush on that front. And if it is a strategy that will work for you, I'll tell you that too. And we can continue pursuing it. So greathousefs.com.
I love that honesty and that clarity. Evan, I've always known you to be a man of your word and a man of integrity. So thank you for doing that both with me, but also with your clients as well. Amanda, how can folks meet you, get to know you? They're intrigued with what you've shared today. What can we do to get in your orbit? Oh, now you're muted.
Sorry, now I was muted. Yeah.
I better mute myself.
No, you're good. You're good. I put a link in our chat to share with the.
Yep.
The
Would you like me to use that?
Sure. Yes, please. So
Okay.
I wrote an article May 9th. It was published this year, so almost 2 months ago from now, that tells our story. So a little bit. So Brandon, my husband, used to work at a bank that got taken over by the FDIC in 2008. So this shares that story, talks a little bit about what the banks are doing with their money. And while you're there, you can subscribe to my Substack where I blog and where our new podcast is. It's livecounterflow.substack.com. You can read, you can listen. Maybe there'll be videos there eventually. But just if you're loving this kind of counter-cultural, let's flow the money back to the normal, ordinary Americans, and away from the banks and those kind of things. This is my home base, and I'd love to see you there. Participate in the comments. We'll have some fun between Fridays when we're here.
livecounterflow.substack.com, and we put the full URL to that exact article in the comments. So that's livecounterflow.substack.com. Thank you, Amanda. And guys, if you haven't already figured it out yet, we're big fans of you. So make sure that you have hung out with us, not just once and done, but you're subscribed to our show. Make sure that you subscribe to the show. Make sure that you hit the like button. Whatever hype does, do that too. Whatever the hype thing does, do it. Do a dance if you want to, because you're just so thrilled with the episode today. Yeah. And then more importantly, share this with a friend who didn't get to see this today, because more than anything else, you hitting the share button, make sure that it gets to the people who need to hear it the most. Your people, your friends, family, and others. Who else besides you do you need to educate about this strategy today? So you can do that by going to the like and subscribe and share buttons down below this video. And if you really want to reach out and talk to us, you can go to nyafinancialpodcast.com. That's where you can meet with me or any of our colleagues and just let us know where you heard about us. So with all that, really want to say thanks to Amanda and Evan for sharing your time. If Brandon Neely's watching, hope you're feeling better, sir. I heard you're under the weather, so we're thinking about you and praying for your